Hi, everybody. Thank you so much for joining us today for our credit and debt virtual workshop. We are going to go ahead and get started. We still have some people joining, but in the interest of time, we will move ahead. My name is Lisa Frankenberger. I'm the manager of counseling services here at Parachute Credit Counseling. We are formerly known as Consumer Credit Counseling Service of Buffalo. Some of you may recognize us as that name. Same company, same people, same great staff, just a new name with Parachute. On the agenda today, we are going to be talking a lot about credit. We're going to talk about your credit report, but also understanding your credit score, how it is, how to understand what pieces of your credit score, make up your total score, how much different parts weigh, and things that you can do to improve your score, build your score, or rebuild your credit. We're also going to talk about some debt management options if you are dealing with debt as well. We do encourage participation in our virtual workshop. So even though we're not all in the same room together, we'd really love your participation. So whether it is putting a comment in the chat, questions in the chat, please feel free to utilize it. I find that a lot of times in our workshops, we equally learn as much from each other as we do the content. So we definitely encourage that. There are going to be some poll questions we launch along the way as well, just to check in with everybody as we go through the material. But again, don't hesitate to put any questions, thoughts, or ideas in the chat as we go through. So jumping right in, credit bureaus. There are three major consumer reporting agencies or credit bureaus that document your history of borrowing and repaying credit. Those three companies are TransUnion, Experian, and Equifax. Everybody is able to get a free copy of their credit report. There are many different sites and services out there that will offer free credit reports. However, a lot of them will say it's free, but put in your credit card information because it's only going to be free for this trial period, and then you might be signing up for some sort of service. The only source authorized by federal law to obtain your credit reports for free is annualcreditreport.com. So through annualcreditreport.com, you are able to get a free copy each year from each of your three credit bureaus, Experian, Equifax, and TransUnion. There's actually been some changes made through the pandemic, and for now, actually through the end of this year, they're actually offering everybody to get free weekly reports. So at this present time, you can actually check them a little bit more frequently. And we always want to make sure that everybody knows pulling your own credit report or score is a soft inquiry, meaning it does not impact your score. So you don't have to be afraid to pull your own credit report if you're going to negatively impact anything. It's never going to hurt you to do it for yourself. And again, the only authorized website is annualcreditreport.com. There are also ways that you can order it by telephone or order it by mail. Through Annual Credit, they don't give you your credit score, which we're going to be talking about in a bit, but it gives you the free credit reports. And really, your credit score is based on the content in your reports. So that's really the first step, is making sure that your information is accurate on there, because that's ultimately what your score is generated from. As far as a credit score goes, it's a number, it's a numerical score, and it's based on the information that is contained within your credit report. Scores typically range anywhere from 300 to 850. And if you really want to, I guess, get down to the nitty-gritty of what a credit score is, it's a measure of risk. Basically, for lenders, they're estimating the risk based on your past payment history, how you're currently handling things. So if you have no credit or if you have poor credit, that's viewed as being a little riskier, right? We don't know exactly how you're going to manage your bills if you have no credit history. So that's why a lot of times people almost equate poor credit with no credit. There's just nothing really for lenders to go off of. The most widely referenced credit score is called a FICO score. That is really what the majority of lenders are using these days. But there are other scoring models out there. For example, there are FICO Next Gen scores, there's Vantage credit scores. A lot of people are familiar with Credit Karma. Vantage scores are what Credit Karma uses. There's Experian Plus scores, and honestly, probably an unending number of other versions and other products that are out there. So it gets a little confusing. You know, I always tell people when they say, what is my credit score? Really, probably have quite a few of them. Different lenders may actually pull different credit scores or see different versions of your score depending on what you're applying for. So for an example, if you are looking to get a car loan, there's a specific auto lending score that creditors use. And it may be different if you get a credit card or get a mortgage. And then again, if you're checking it on your own through a service like Credit Karma. So the different models may result in different scores, but this is why we get back to the content of your report really being the most important thing, because no matter what credit scoring model those lenders are using to look at, it's all based off the content in your report. So as long as we know that your report is in good shape and we're generally following good credit practices, you should have a good score no matter what the model is. And we'll get into specifics coming up here. So we're going to look at how a FICO score is made up because it is the most widely used. However, these guidelines pretty much are good practice no matter what the scoring model is. So these are just good foundational things to learn and to know to ensure that your credit score is the best it can be. So as you can see here, the biggest piece of the pie here is your payment history. And this is going to include, you know, just how you've made your payments in the past. And we're going to, drill down into specifics on each of these going forward. The next biggest part of your credit score here is your amounts owed and your credit utilization. This is not just how much you owe overall, but how much of your available credit you're using. Length of credit history is 15%, as we can see here. How long have you been using credit? And then the final two parts are 10% each. One is new credit or inquiries, which we'll talk about a little more in depth. And then the final being types of credit used, having a mix of credit. So the big one, payment history. Again, this is the largest part of your credit score, definitely the most impactful. This is how you have made your payments. Do you have late payments? Do you have collection accounts? Those sort of things. So if you're looking to improve or build this part of your credit score, you can do so by making sure you make all of your payments on time. Make sure you are at least making your minimum payment 100% of the time. Usually, your account is not going to actually report that it's past due to the credit bureau until it's at least 30 days past due. So if it's one of those things, you miss your due date by a couple of days and you're, oh my gosh, I don't want this to affect my credit. Generally speaking, if you make that payment up, before the next bill is due, it's typically not going to show up on your credit report, although of course you will most likely get a late fee. But the other thing with this part of your score is avoiding, having collection accounts out there, bankruptcies, these sort of derogatory items, and also just allowing time to pass. So the longer it's been since the delinquency was reported, the less it's going to impact your credit score. So say, negative information typically stays on your credit report for 7 years. So let's say you've only had, one late mark on your credit report. It happened 5 years ago. It's probably not going to weigh super heavily on your score at this point because it was kind of a minor late mark. It was many years ago. But that being said, that's why it's super important to keep your current stuff current. What you're doing now with your credit is always going to kind of impact your score the most. What is happening now in your credit, not necessarily, it's not going to, weigh, it's going to weigh a lot more heavily than something that happened many years ago. Outstanding debt or credit utilization, this is 30% of your credit score. And I always call this the tricky part of your credit score. This is a little sneaky, and a lot of people don't realize the amount of impact this part of your score can have. So again, this is just how much you owe altogether, but also on your revolving credit lines. This means like credit cards, lines of credit. How much of your credit limit are you actually using? So this goes a little bit against logic. And what I mean by that is this. Let's say that you have a credit card with $1,000 limit on it. You should be able to charge $999 on that credit card. And as long as you're making your payments on time, you're under your credit limit, you should be good, right? Actually not. Your credit score can start lowering because it looks like you are using all of your available credit. You're maxing out that credit card. The key to keeping this part of your credit score in good shape is to try to use less than 30% of your available credit. So it's kind of easier to remember. It's 30% of your score. Try to keep your credit utilization to less than 30% of your limit. So we give an example here for a credit card with a $10,000 limit. Try to not have your balance ever go above $3,000. $3,000 is 30% of $10,000. In a perfect world, we'd be able to pay our credit cards in full month to month and, not carry a balance. So we're not being charged interest, but we also know very well that the world is not perfect. So there are going to be times you may have to lean on your credit cards more heavily, or if you have really high interest rates, you're having difficulty making progress on paying those credit cards down. Another kind of sneaky part of this that I always like to mention to people is that the goal is really to never charge more than 30% of your limit. We'll have folks come in sometimes and say, I have a rewards credit card. So what I do is I pay all my bills with my credit card so I can get rewards points, but I always pay it in full at the end of the month. In theory, that's great, right? There should be no issue. However, every lender typically reports to your credit bureau just once per month. You don't necessarily know what time of the month your balance is being reported by your creditor to the credit bureau. So if you have that $1,000 limit, your bills total $800 per month, you're charging that $800, you do pay it in full when the bill comes. If the bank or lender reports your balance to the credit report, when that $800 is on there, it's still going to look like you're using 80% of your available credit, and that could lower your credit score. So again, the key with this is trying to never have your balance go above that 30%. The lower, the better. If you can keep it to 20, 15, 10, of course, all of that is always better. But generally speaking, if we can keep it under that 30%, you're going to be in pretty good shape credit-wise. The other part of this is leaving unused accounts open. A lot of people think that if you have open credit cards out there that you're not using, it looks like potential debt or, something in some way that's negative. That's not a thing. If you have open accounts, if they have zero balances, that's not viewed as a negative in any sense of the word. It's not looked at as potential debt. Really, lenders are looking at actual debt and actual utilization. So not only is this sort of 30% ratio, does it apply to your individual accounts? It also applies as a whole overall. So like with all of the credit limits on all of your cards, and then how much you owe in debt, there's like an overall ratio too. How much of your available credit are you using? So when you leave unused accounts open, that entire, credit limit is available and being counted into this ratio. So it could actually help you overall leaving those accounts open. As long as there's no annual fee or anything goofy that you're being charged to have the card. That also comes into play with your length of credit history. Again, this is 15% of your score. Some of this, especially if you're younger or just starting out credit-wise, you can't help. It's if you're new to credit, it's going to take a little bit to kind of bulk up this part of your score. But it's how long you've had accounts open. So leaving your longest standing accounts open can really be helpful. If you can show you've had a relationship for over, 10 years with a creditor, that helps your overall length of credit history. It's in your length of credit history is an average of the ages of all of your accounts. So the less newer ones you have, the better, technically. And we just generally recommend not proactively closing accounts. A lot of times people will say, well, I'm never going to use this credit card again, or I don't care if it closes, as soon as I get it paid off, I'm going to close it. That can unintentionally damage your score, especially if it's an account that you've had for a while. So unless there's a good reason to close it, meaning, say you're going on some sort of internal program with your creditor or a debt management plan to get you out of debt, or if you know that you just kind of can't trust yourself with having that available credit and you think that you'll charge too much, those are all perfectly good reasons to close an account. We just say don't close accounts for no reason, if that makes sense. Now, if you haven't used a credit card in a while, it will eventually close due to inactivity. The lender will close it out. So with your longest standing accounts, even if you don't use them regularly or it's not used on a daily basis or anything like that, try to use it at least once every 6 months or so. You can just make a small purchase, pay the balance off in full when that bill comes, so you're not charged any interest, but it keeps it active. If your lenders think there is a chance they're going to make money off of you, they will keep that account open. So again, with your longest standing accounts, try to use them periodically so they do stay open for you. New credit or inquiries is 10% of your score. So every time you apply for credit, it is an inquiry, or sometimes it's called a hard hit. There's hard hit, soft hit, hard inquiry, soft inquiry. Hard inquiries are, again, when you are applying for something and somebody is checking your credit for credit worthiness to try to approve you for something. So typically this is lenders. When you pull your own credit report, it is a soft hit on your credit. It does not affect your score. And when agencies such as us pull your credit, because we're not a lender, if you were to come to Parachute and we pulled your credit score, it's a soft pull on your credit. The more inquiries you have, it can start to look risky, like we talked about before, right? It's all a measure of risk. So you could very easily affect this part of your score unintentionally. Say you're doing some holiday shopping and, you're in the mall and every retail store is offering you, 15% off if you open up a card with us. So you're thinking, well, hey, I can make some of these purchases, open up these accounts. It'll save me a little bit of money. But if you do this a few times, especially in a short period of time, if you look at it from a, risk perspective, it's sort of like, well, what's going on with this person that all of a sudden they're opening all these accounts? Do they not have funds to pay for it? Are they struggling financially? It just appears a bit more risky to open a number of things in a short period of time. So we recommend really only applying for credit when you absolutely need to. We say strive to have no more than a few hard inquiries on your credit report per year. They only stay on your credit report for 2 years. So it's not the hugest thing, and it's only 10% of your score. But if you're working to build or rebuild your credit and trying to get it, in as good a shape as possible, especially if you're working toward a goal of maybe buying a home or something like that, this is important to consider. Now, there is kind of a loophole that exists, which is really nice. If you're shopping for a mortgage or shopping for an auto loan, as long as you put in those applications within a 14-day period, it's only going to count like you have one inquiry on your credit report. So this sort of allows you to shop around a little bit. I'm sure many of us know if we were to go to like a car dealership and have them run our credit, sometimes they're running it through 8 different lenders, and we're thinking, oh my goodness, now there's going to be all these hard inquiries. But again, if they're done within a 14-day period, it kind of balances out and only accounts against you once. So don't be afraid to shop around for those things. And I got ahead of myself, which I tend to do. I apologize. This just goes over the type of inquiries here. So the difference between the hard and the soft inquiries. Soft inquiries are also things like promotional credit offers. You get an offer from a credit card company, saying you're pre-approved. Those are soft inquiries. It means they're kind of scanning your credit profile to see if they want to market to you, but it is not actually affecting your score. So if you're not initiating that transaction of like an application, it's not going to be a hard inquiry. Final 10% of your score, types of credit and use. This is, again, a small portion. It's only 10%. But showing that you've managed a mix of different type of credit can be helpful here. So say if you have a loan and a credit card, it's showing that you can effectively manage different types of debt. And so again, not a huge deal, but important to know that it's out there and it's counted as part of it. Now, I think we all pretty much know that our credit score is impactful, especially when it comes to obtaining credit, but really it can affect us a lot more. Of course, it affects your ability to obtain credit, but it's also going to help determine your interest rate, which ultimately is how much you pay for something. So if you have poor credit, you probably are going to have a higher interest rate, whereas if you have good credit, you'll have a lower interest rate and just a more affordable cost overall. It also, though, can affect your ability to rent an apartment, obviously for home ownership, approval of utility services. And a lot of people don't realize it actually can affect the cost of your insurance. So say for like auto insurance, a credit report is part of that process. And the poorer your credit score is, you may be paying higher insurance rates because of that. And even employment. There are many employers out there to check credit prior to hiring. And, whether you agree with it, be it right or wrong, these are things that, a lot of times I think we think, I have poor credit, but no big deal. I'm not going to be getting a loan anytime soon. I'm not going to be doing that. But if you're looking for a new job, shopping insurance, looking to move, it can impact us in all these other ways. So when, sometimes people have questions around, why do employers look at credit? What are they looking for? Sometimes they're looking just to assess accountability and responsibility. Are you taking care of your business? Are things on time? They also can be just trying to verify information that you put on your application or to potentially check for fraud or other illegal activities. And it can actually be a hindrance to getting a job in certain fields, certain areas of the financial sector, the government, the Defense Department, pharmaceuticals. Sometimes if you do not meet a minimum credit score or you have different things going on your credit report, they may not extend you the job offer because they do have minimum requirements. You do always have to provide consent, though. A potential employer cannot just pull your credit report without your consent. So you're always going to know if it's going to happen. So again, the higher your credit score is, the more likely you're going to be approved, but also you're typically going to pay less for that credit that you're borrowing. You're going to have a better interest rate. So good credit costs less because of your increased ability to repay, lower interest rates for borrowing. And when you have bad credit, it can cost you more because it's potentially showing a decreased ability to repay and then equates to higher interest rates and fees for borrowing. So the best way to use credit cards to help you build good credit is really just trying to use them when you have the ability to pay the balance in full every month. That way you're not, carrying debt month to month, and you're also not getting hit with high interest rates that you're having to pay. So in other ways that poor credit can affect you, if you don't qualify for a loan, you may need to use a rent-to-own service for household goods. It can cost you twice the amount. Twice is generous. Oftentimes we see these things actually costing 3 times the amount you would normally pay or more. Short-term title loans can end up costing you your property. Sometimes, a place may give you a loan, but say, hey, you have to put up some of your household goods or your vehicle as collateral. And again, lenders can charge excessive fees and interest. So we give you a little example here. If you take out a $20,000 auto loan for 5 years, if you have a 720 credit score, you get approved at a 5% interest rate. Your monthly payment is $373. And over those 5 years, you only pay about $2,400 in interest. Now, if you get that same $20,000 5-year auto loan with a 590 credit score, your interest rate is almost 19%. You're also paying more than $100 more per month on that payment. Your payment's going to be $499, and you pay almost 10 grand in interest over those 5 years. So it not only costs you in the long run with interest, it also increases your monthly payment. So you're really, in a bad situation in multiple ways. So it's great that credit can still be available to us when our credit scores are down, but we end up paying a lot for it. So when you're carrying a balance month to month on revolving accounts like lines of credit and credit cards, as opposed to paying them in full each month, the amount of interest that you can pay over time can blow your mind, honestly. So we give an example here. You purchase a new living room set, it's $2,000. You put that on your credit card and you make your minimum payments. With roughly a 2% minimum, 18% interest rate, which is not terrible, not great, but kind of middle of the road right now. It would take you 24 years to pay off that $2,000 purchase. If you still had that furniture in 24 years, you'd also be very lucky. And with interest, you're paying over $6,000. It's basically equates to over 300% more than the retail price. And again, after 24 years, would you even have that? And if so, what would its value be? So the minimum payment trap is a real thing. So we just give you some examples here. Again, all things being equal, 18% interest rate across the board. This is, a required minimum payment of about 2.5% of your balance. If you only make your minimum, 10 grand is going to take you 29 years, and you will have paid over $24,000 by the end of it. You bump that up to 25,000. Now you're looking at 36 years of repayment, and over $61,000 paid by the end of it. 18% interest rate is not even that bad these days. We see a lot of folks, you have 28%, 29%, and these numbers get even worse. So it's really important to not fall into that minimum payment trap. Look at it and say, okay, I'm only going to charge this if I have a plan to get it paid off quickly. If I know I can pay more than my minimum, because this stuff can add up. And then you spread that amongst a few different credit cards, and it's just crazy. It feels like you can never get out of it. We're going to talk about a couple quick credit terms, introductory or promotional interest. So sometimes you'll see an offer that'll say it's 0% introductory, but you have to pay attention to what that interest rate is going to be after the promotional period is done. Let's say you get 12 months of 0% interest. That's great. But if it's 27%, you know, at the end of that 12 months, is that really a good deal? Is that really going to help you? Also, deferred interest is a big thing. So there's definitely some things out there, like it can happen with furniture purchases or sometimes with like medical type credit cards. They'll say no interest for 6 months. But when it's deferred interest, what that means is that interest is still accruing. It's just not being added onto your balance. So if you pay that purchase off within 6 months, you're never charged that interest, right? If you don't pay it off in the 6 months, what they do is they take all that interest that's been accruing on the side and now add it onto your balance. So now you're going to pay interest going forward on a higher amount than you even borrowed. So just being really aware, you know, if you're looking at an introductory period, or is this a deferred interest? And then variable interest rates. Most credit cards are variable. That means that if interest rates change, overall, the interest rate's also going to change on your credit card. So in the recent past, interest rates have been going up. You know, there's been multiple interest rate increases. So you may have noticed on your own credit cards or, you know, other things you have that your interest rate is going up. That means it's ultimately going to cost you more. We're going to launch a quick little poll here for you guys, just checking in on understanding. So if you just take a moment and answer the poll question on your screen. The question is, pulling your own credit report will impact your credit score. Is this true or false? So I'll just give that a second. We've had about half of our people respond. All right, you guys are rock stars. That is false. We got 100% with the correct answer. Pulling your own credit report is never going to impact your credit score. Good job. So as far as rebuilding your credit goes, we're going to talk a bit about that. So if you have established credit, but you're struggling to improve your credit score, these are some strategies that you can use to help you get to where you want to go. Number one, make all of your payments on time every time. So if ever you're in a situation where you're like, oh my gosh, there was an emergency, I don't know if I'm going to be able to, you know, make my car payment this month, or, you know, or my credit card payment this month, contact your lender immediately if you're having trouble making your payments. You know, sometimes there may be arrangements that are able to be made, you know, payment plans, different things like that. So always keep your lenders in the loop with what's going on. The other thing is to keep that credit utilization to under 30%. Not charging more than 30% of your available credit limit is going to help keep your score in a great place. And this is, again, even if you pay off your balances in full every month, never let that balance go above 30%. And if we take a moment here to pause, your payment history and your credit utilization is 30% and 35% of your credit score. That's 2/3 essentially of your credit score is made up by these two things. So if there's anything you are going to focus on, these are the most important. Be strategic about taking on new debt and closing accounts. As we talked about earlier, you don't want to have too many hard inquiries, and think twice about closing old accounts. Now, if you have an older account that is charging you a fee, you know, annually or monthly to keep it open, it's not cost effective. Okay, that's a good reason to close that account. But it's almost always better to keep it open if you can. And regularly monitor your credit report for inaccuracies. You would be amazed at how common mistakes are. I've had it happen to me. It's happened to many people I know. It happens all the time with clients that we see. So this way, if you're keeping track of your credit report and monitoring it, you'll be able to recognize and dispute any errors that have the potential to negatively impact you. I always like to share this story. This happened many years ago, but I had a client who was trying to take a home equity loan. He wanted to do some remodeling on his home. And he said, you know, I haven't looked at my credit report or score in many years. I don't really have debt. I make all my payments on time, so I figure I'm good. Well, when he went to a lender, he was declined. He went to another lender and he was declined. So he came to us and said, I have to figure out what's going on because my credit should be in good shape. Now, the lenders at the time were just saying, you'll get a letter, because we'll talk about in a bit. If you're denied credit, you will get a reason, but he wasn't being given an immediate reason. Well, when we pulled up his credit report, it said he was deceased. And that was the reason that he was being denied credit, because it was showing he was deceased. And he obviously wasn't. He was right in front of me. But what happened was, he was a junior and he had the same name as his father. And unfortunately, some wires got crossed. And when his father passed away, it ended up on his credit report. He did get it straightened out. Everything worked out, but it's kind of scary to think, right? And especially if you can get a free copy of your credit report every single year, check it. Why not? What I recommend a lot of people do is maybe around like tax time every year, we all have to file our income taxes. That might be a good time to go in and check your 3 reports. Or what some people will do is pull one of them every 4 months, just so you're kind of having a look, throughout the year. And should we have 3 different credit reports? Up for debate, but that's the system we're working within. So you really do have to make sure that all 3 reports are accurate, because they can report different information. You also want to utilize your credit strategically and wisely. You don't want to use credit cards to supplement your income. Again, only use those credit cards if you really have the ability to repay. And again, try to aim for only charging a few items monthly and pay that balance in full. So if you're in a situation that you have primarily negative information on your report or no credit, these are some strategies you can consider. So if you currently don't have a credit card and your credit score is low, consider a secured credit card from a bank or credit union. A secured credit card is a normal credit card in that it will report on your credit bureaus, to report your payment history, all of that. But it's hard to get approved for a traditional credit card when you have no credit or poor credit. So what you do with a secured credit card is you're essentially putting down a security deposit. Typically, you anywhere from $500 to maybe $50 to $500 as a security deposit, and the bank holds on to that money. So that way, if you were to miss your payments, or whatever, they have that initial deposit that they can keep. So there's less risk to the lender. A lot of secure cards do charge annual fees and have some higher interest rates, but it's basically a tool, a short-term tool that you can use to build your credit to a point where you can qualify for a traditional credit card or a traditional loan, and be able to close out that secured card. That is one situation that I would say it's okay to close it if it means you're getting your deposit back. Many lenders nowadays will actually just after 6 months or a year of consistent on-time payment and wise utilization of your credit card, they'll actually turn it into a regular card after 6 or 12 months. You get your deposit credited back to your account, and then it's just a normal credit card going forward. But it's a really great tool to help you if you're kind of just starting out credit wise, or if you're really trying to rebuild. There's also credit building loans that are out there. A lot of times they're offered through credit unions or community banks, but there are online lenders as well. And typically the way a secured loan or credit building loan works is you're paying monthly installments. So you're making monthly payments on your loan, right? But it's actually going into a savings account. At the end of the term, which usually is like a year, 2 years, you actually get the balance back of that savings account minus any interest or fees that the lender take for, basically that's their fee, right? And you utilizing their product. When you're looking at different, lending offers, you do want to shop around a bit. Try to look for something that has no annual fee or at least a low annual fee, no application fees. And a lot of credit card companies out there are offering a free credit score to use. So that might be an added benefit. Definitely make sure, though, that the lender reports to all three credit bureaus. With most major lenders, this is not an issue. However, sometimes really small community banks or credit unions may only report to one or two credit bureaus. So make sure you're finding that out, because a future lender can pull any of your three credit reports. They can pull all three of your credit reports. You don't necessarily know what they're pulling. So we want to make sure whatever you're doing is reporting on all three of those reports. There's many websites out there, different tools you can use to shop around. There's Bankrate, creditcards.com, NerdWallet, just to name a few. There's also something that exists called Experian Boost. Now, this only impacts your Experian credit report. It's only through them, but it's a free service that allows you to connect payment history on non-traditional credit lines. So this could be like your cell phone bill, your rent, utilities, and it'll actually start reporting on your Experian credit report. So that can boost your score up a little bit if you're working on your credit. But again, it only applies to one of your three, and you don't know what potential lenders, which credit report they're going to pull. So keep that in mind. It's an extra thing you can do, but you really want to make sure you're adopting some of these other strategies that go to all three credit reports. If you have a young adult in your life that is, looking to establish credit, these are some things that you can think about. You may be able to add them as an authorized user onto one of your accounts. When you add an authorized user onto your credit account, the authorized user kind of gets to ride your coattails, right? They get to, that credit card's payment history and all of that will show up on their credit report. Now it's going to show they're only authorized on the account. And what that means is they could potentially use the account. It's going to show up on their credit report, but they are not legally responsible to pay for any of that debt. So you want to be careful. You can absolutely add somebody on as an authorized user and not give them access to a card. So say you're trying to help somebody build up their credit, but you don't necessarily want them to use your account. You can add them on, but just not actually give them a physical credit card. You can also potentially co-sign for a loan or credit card to help them qualify. But again, be careful with co-signing, because if the primary borrower, your young adult or whoever it is you're helping, can't make payments, the responsibility is going to fall on you, and it's going to impact your credit as well. Or you can encourage them to obtain a low limit credit card or secured card like we talked about, teach them how they work and encourage minimal and responsible usage. If you're denied credit, ask the creditor to be specific. Why? Unspecified or vague reasons for denial are actually illegal. Through the Equal Credit Opportunity Act, you have the right to obtain the reason why your credit application was denied within 30 days. So typically your lenders will send you a letter and say, this is why we denied your application. And it gives you the opportunity to obtain a copy of your credit report for free if you request it. So you can sort of see what they were looking at. Quick little note on predatory lending. Predatory lenders often prey on people that have a low credit score, and how they're predatory is they charge exorbitant fees and interest. So how to spot something that is potentially predatory? Again, excessive fees for everything, fees for making a payment, fees for the application, fees for prepaying, interest rates higher than 30%. Or a balloon payment. So it might be like, okay, well, your payment's going to be $200 for the next 3 years, but then at that 3-year mark, the remaining $12,000 of your loan is due. That's a dangerous game to play. If they have prepayment penalties, if anybody's trying to rush you, this offer is only good today. If you want this deal, you have to sign this today. Things like that, the kind of high pressure often can be predatory. Asking you to lie on an application or leaving things blank, like, oh, just sign this here, we'll fill in the rest later. Please never do that. Never, ever do that. I'm going to launch just another quick poll here to do another check-in. You guys will take a moment and answer the poll on your screen. You have more than one credit score, true or false? True or false, you have more than one credit score. Again, rock stars, true, absolutely. You have many, many, many versions of your credit score. So if you get a lot of junk mail, pre-approved credit offers, you want to stop many of them from coming in. You can either go to optoutprescreen.com or call the number on your screen. The only thing is it will stop kind of the random offers that come, but if you have a relationship already established with a lender, a lot of times you have to opt out with that lender specifically. So say if my credit card is through Chase, I have a relationship with them. Chase may continue to send me marketing offers even if I've done the opting out. So I would have to individually opt out with Chase. And now we're going to talk about a little bit about dealing with debt if you have debt out there. There are many, many, many solutions and options to managing one's debt. Every single person's financial situation is unique, and each situation will have its own best solution. So we're going to talk about a few different things, but it really depends on your circumstances and situation. So the power payment method, it's called a million different things. It's also called the snowball method. It's been around forever. It's a self-administered thing. You do this yourself, and you repay your debts by paying accounts with the highest interest rates first and paying more than the minimums. So essentially what you would do is you would order your debts by interest rates, high to low. You make your required minimum payment on everybody, of course, but any extra money you have, you target that highest interest rate account first, so it gets paid off more quickly. Once it's paid off, you take the money you were sending to them, apply it to your next highest interest rate creditor, and so on. You can also do this by balance order. You can order your accounts the lowest balance to the highest balance and start paying things off that way. You do typically pay off accounts in about a third of the time it would take you otherwise using the power payment method. Of course, that means less interest. The disadvantage to this, though, is you need to have that extra money to work with in the first place so you can comfortably pay your minimums and pay extra to really make this method work. A debt management plan is working with a nonprofit credit counseling agency to develop a plan to pay off your unsecured debts, so credit cards, things like that, in full within 5 years or less. The advantages are typically greatly reduced interest rates, having one convenient monthly payment. It potentially can reduce your monthly payments, stop late and over limit fees, and potentially help increase your credit score over the long term. Disadvantages to a debt management plan is typically the creditors will close your accounts, and there can be a potential short-term credit score decrease, but typically you do rebound from that within 6 months to a year. This is just an illustration here we give you on how a debt management plan can really help. So we take that first example we looked at earlier, $10,000 of debt at 18% interest with a minimum payment. We already know it takes us 29 years to pay off. But let's say through a debt management plan, we can get those credit card interest rates down to around 7%, and making a little bit lower of a minimum payment. That 10 grand actually only takes you 5 years to pay off. You only pay about $1,800 in interest. You have saved yourself not only 24 years of your life, but you have also saved yourself over $12,000 in interest. So this is a good example of how a debt management plan can help. And especially most credit cards these days, again, do have very high interest rates, so it makes it difficult to make progress on them. There's also consolidation loans. This is like an unsecured loan that you use to pay off your other outstanding debts. It also gives you one convenient monthly payment, potentially reduced monthly payment, but you do generally have to have good credit to get approved. It may stretch your repayment period out longer, and it may not even be enough to cover all the debt you have. Home equity loans is a secured loan taking against your home's equity that would be used to pay off, your outstanding debt. Advantages is usually lowering your payment. The interest that is paid is tax deductible because now it's a mortgage product, it's a home equity loan. The disadvantage of this is you're taking unsecured debt that you potentially could have filed bankruptcy on if need be, and you've transferred it to secured debt, meaning if you don't make those payments, you could lose your home. Debt settlement is negotiating with your creditors to pay a lesser amount than your balance in full and consider that account taken care of. So this typically is when you have accounts in collections. This isn't usually something you can do if your accounts are current. But say, you've had a hard time, your debt is, months or years past due. There's been a lot of interest and stuff that is added on there. You may be able to negotiate to pay less than that full amount, and it makes it quicker, right, for you to get out of debt. Disadvantages, it is going to reflect as settled on your credit report rather than paid in full, which is technically more negative. That can lower your credit score, and there are potential tax implications. Any debt that you settle, if your creditor forgives more than $600 of your balance, the amount forgiven is considered taxable income. You're going to have to pay income tax on it, so you don't get off totally free with that. And then there's bankruptcy, and that's a legal proceeding filed in the U.S. Bankruptcy Court. For consumers, there's Chapter 7 and there's Chapter 13. Chapter 13 is a payment plan over 3 to 5 years. Chapter 7 is typically kind of wiping the slate clean. We do usually consider this the option of last resort. It can pretty significantly lower your credit score. Typically it takes people about 2 to 4 years to rebuild their credit back to a good place. But the bankruptcy does report on your credit report to 7 to 10 years. And there's some, harder deadlines in there, meaning, if you are looking to buy a house, typically you're at least waiting 2 to 4 years before a mortgage lender will even talk to you about that. So it's something that, definitely is something that needs to be thought about seriously, and, to review all of your options. Speaking of reviewing all of your options, that's exactly what we do here at Parachute. So after we've talked about all this stuff, if you guys have questions, concerns, want to maybe talk to somebody to take a look at your situation, our contact information is on the screen. One of our most popular sessions is where we review people's unsecured debt options, and we go over all those different things that we talked about today to see what ultimately would work best for you in your unique financial position. We also help with credit reviews, helping you understand your credit, teaching you more, and giving you a one-on-one individualized look at your situation. We offer free student loan counseling. Student loan repayment is going to be kicking in soon. So if you or anybody could use to talk to somebody, please reach out. We would be so happy to hear from you. And I am going to launch just one more poll for you folks. We like to just launch an end of webinar survey. If you could please give your honest feedback on our presentation today, it's super helpful. So I'll give everybody a moment to do that. And I know we really didn't have any questions today. Hopefully that means the information was clear. If anybody wants a copy of the presentation, please reach out. I can send a recording or copy of the slides. Again, if you don't mind completing that end of webinar survey, much appreciated. And it looks like we'll be able to give you your last 5 minutes back. Thank you so much for everybody who joined us today for your participation in the polls that we launched. And again, we are here to help. Anything you need, any questions you have, please reach out. Even if we can't help you, we're going to point you in the right direction. So thank you so much for joining us today. and I hope you enjoy the rest of your day.